Hey all, welcome to ShareTreck where science meets investments and I'm your host Raj. Friends, today we are revisiting an old friend, Ginkgo Bioworks. We haven't spoken about it for a while. Today we are looking at Ginkgo Bioworks, ticker symbol DNA. And we are going to look at how it's navigating a volatile 2025. There seems to be strong revenue growth and promising projects underway, but also increasing pressure from US tariffs and valuation concerns. So let's break it all down in today's video. Let's get started. Welcome back, friends. As of late July 2025, Ginkgo stock has been trading in a fairly wide band from $12.56 all the way to $13.81 intraday. It recently dropped by 7.45% on July 29th, following an earlier dip of 6.31% the same week. This is an example of the kind of volatility this stock continues to show. On a broader scale, its 52-week range runs all the way from $5 to $16.85, which is a nearly 240% swing. So yes, this is still a very high-risk play. One has to be very careful with this stock. Ginkgo reported year-over-year revenue growth of 27%, with recent quarterly revenue hovering around $44 to $48 million. The cell engineering segment showed gains, while biosecurity stayed flat. Despite continued net losses, both EBITDA and loss margins are showing improvement. They also retain over $500 million in cash, giving them a good cash runway. And I remember last time I made a Ginkgo Bioworks video, they had a $1 billion cash stack. For full year 2025, the company guided for 160 to 187 million in revenue, which does signal confidence in its scaling potential. Well, friends, please press like if you're watching the video so far and you like this channel. It'll help the channel grow and help us with the YouTube algorithms. That said, let's dive back into our analysis. Ginkgo has been busy forming new partnership. One of the standout projects is with Phytolong, and it's focused on developing natural food colors. Natural food colors become important with RFK Jr. at the head of FDA. Ginkgo have achieved manufacturing efficiency gains with pigments like beetroot red and prickly pear yellow. And if you recollect, recently the FDA had asked many vendors to remove the artificial red color that they use in their products. So I think this initiative of Ginkgo is definitely bound to yield a lot of results. Another major program is WHEAT, which aims to manufacture complex active pharmaceutical ingredients, or APIs, which are precursors that are used for making pharmaceuticals. Using Ginkgo's programmable cell tech and AI tools, this is a long-term initiative from Ginkgo, but it's a good example of how Ginkgo is targeting multi-industry application of synthetic biology, and probably it's one of the only companies in this area which is making these initiatives, so it has got the front-runner advantage. Ginkgo stock is still volatile. Some short and long-term moving averages show buy signals, but recent pivot point indicators and MACD flash near-term sell signals. That said, analyst sentiments remain mixed. Most firms maintain a sell or underweight rating with price targets well below current levels. That reflects ongoing concerns about profitability and not just growth. Now let's talk valuations. Ginkgo trades at a price to sales ratio of around 2.3x, which is well above the biotech industry average of 1.1x or less. EPS remains deeply negative at minus 8.91, and cash burn is still a concern. So while revenue is growing, the current valuation might be hard to justify unless we see much stronger performance in profitability and cost controls. Now here is where macro factors come in. 2025 tariffs. There has been no official word from Ginkgo on this, but biotech broadly is under pressure. Over 80% of the raw materials and APIs used in US life sciences come from countries like China and India, many of which are now subject to 10 to 50% tariffs. And if you recollect, The talks with China recently were inconclusive with regard to tariff, and India has still not done any trade with US with regard to the tariffs. So we have to watch that space. For Ginkgo, this could mean higher input costs from reagents and lab equipment, margin pressure in an already loss-making business, and supply chain delays, as well as regulatory slowdowns due to changing suppliers. So if you're betting on Ginkgo long-term growth, these trade risks are now a real factor in the story. Now let's talk about the takeaways. Ginkgo Bioworks is making real progress, both in terms of platform development and revenue growth. That's the positive side. But it still has a long way in terms of profitability, and external headwinds from tariffs, supply chain pressures, and valuation premiums cannot be ignored. So that's the kind of summary that I would like to make. And with that said, given the fact that the analyst price target is below the current price range, we have to be very cautious when they come up for earnings, and the chances of the prices going down is much higher than the chance of the price going up, especially given the EPS being so bad. So friends, that brings me to an end of this video. Thanks for watching this video. If you're not yet subscribed, can you please subscribe and help grow the channel? This brings me to an end of this video. Bye for now.